Hey everybody, back with another video, and today I'm going to be answering a question that I've been getting probably a few dozen times, and I'm finally just going to get around to it, and that question is, should you be putting your cash into short-term bonds instead of just holding it as cash? This is a very nuanced answer. It has a lot of different components, but I'm going to try and break it down as simply as possible. The reason that people would put money into bonds, especially short-term bonds, instead of cash at this particular time is because they still want to get some kind of return, but they really want to hedge their risks from equities or longer dated bonds. Bonds are not a safe investment, no matter what anyone will tell you. There is no such thing as a safe investment, but they are one of the safest investment. Outside of something that's insured, like a savings account or CDs, the next thing would be money market funds, and then you would go into short-term bonds, first government, then corporate investment, then corporate junk rating. So we're going to talk about how safe this is, should you be doing it, what's the environment, things like that. First of all, we'll take a peek at a bond fund. I like ISTB because it is an aggregate, a core short-term bond fund. It has treasuries, it has investment grade bonds from all kinds of companies. It's a good reflection of the short-term bond market. So if we look back over its history, we can see that during the crash, when the S&P and the NASDAQ both dropped close to 30%, I think one of them was over 30%, ISTB only fell about 5% and then quickly recovered. We could see that within 2 months, it was over where it was before the stock market crash in 2020. Now, the reason that it recovered so quickly was because we had interest rates hovering at about 2.5%. So when the economy went to crap, as it were, the Fed cut their short-term interest rate to 0, which meant that the bond prices went up because their yields started to decrease. And if you know anything about bonds, price and yield are inversely correlated. So what would you do now? If you're afraid of a market crash, you're probably going to see a similar drop as you saw with this. If the markets were to crash, 50%, your short-term bonds might fall 5 to 10%, maybe 15% if things were really awful. But they won't be anywhere near what equities or longer dated bonds will fall. Now, the other thing you have to be worried about when you hold bonds is, as I talked about, interest rates. There is interest rate risk in all bonds. As interest rates go up, bond yields go up. And since there is an inverse correlation, as the yields go up, the prices will go down. Now, since we are in a 0% interest rate environment, and we have been for essentially the last, what is this now, 12 years with only a slight spike for a couple years, interest rates have to go up to combat inflation. If interest rates don't go up, inflation keeps chugging along. We stay in this hyperinflationary market that we're currently in, and your cash becomes worth nothing. So interest rates will have to increase in the future, probably in 2023, possibly in 2022. If they do not go up by then, or even before then, you can consider this hyperinflation to continue to go on, and your cash to keep eroding in value. So, do you want to put your money in short-term bonds? Is it something that you should do? There have to be two things you have to be concerned of if you're thinking about doing this. You have to be scared of a market crash. You have to think it is not necessarily imminent, but a foregone conclusion. If you're like me, I do think the market will suffer some kind of crash, at least a correction in the next 2 to 3 months, and possibly a crash of epic proportions sometime in the next 2 to 3 years. The other reason that you put money into short-term bonds is that you want to preserve your capital. As I said, the drops are going to be much less severe than equities or longer dated bonds. So if you're okay with losing, 5 or 10% of your portfolio, but not 30 to 40% or more, this might be something you're willing to do. Now, ISTB, for example, only currently pays about 1.8% yield, and over the last 5 to 10 years, it's only returned about 2%. So this isn't really something to look at as a long-term investment unless you are terrified, absolutely terrified of losing any kind of money. This really would be just a hedge. I think the markets are going to crash, but I still want to have money deployed. I want to get some kind of return, some kind of yield. I have cash sitting around that's doing nothing. Let me just put it in this so that I'm not getting, my savings account interest at 0.01% or something like that. Another thing to remember is that if you do think there is going to be a crash, remember that cash is king no matter what anyone else says. You can't buy food and you can't pay your mortgage or your rent with bonds or stocks or any kind of security. In the end, holding cash does have its advantages, but if you're looking for some kind of yield, short-term bonds might be a good idea for you. But I would say do more than just look at this video. You need to do a lot of research. You have to understand a lot about bonds, about bond funds for that to be a choice of yours. I have a little back test here showing we have ISTB versus the S&P 500 and a conservative allocation ETF. And as you can see, over the last 8 years, short-term bonds have returned only about 20% over the 10 years, while of course the S&P has returned about 360%, and a conservative allocation would have returned about 86%. So just know that if you do something like this, your returns are going to be minuscule compared to the market if it continues to go up. However, with that comes, your drawdowns will be much less severe. As you can see here, a drawdown for the S&P of 20%, whereas for ISTB, the max drawdown was 1.29%. So just be aware of that. Just know, do that kind of research. Look at what your risk profile is, what your time frame is, those kind of things. You also want to keep an eye out on treasury yields, and particularly for short-term bonds, particularly the 2-year. The 3-year, the 5-year are really important because those are where a lot of your bonds are going to be sitting at. Most under 2 years they're usually going to be moved to ultra short term. That's where your 90-day T-bills and stuff like that. Most of your bond funds are going to be sitting between 2 to 5 years. For example, ISTB is 1 to 5 years, so for that you would be looking at the 1 year, 2 year, 3 year, and 5 year treasury rates. When these rates go up, the yield on your bonds are going to go up, but the prices are likely to go down. You also need to look at the companies that are issuing corporate bonds in your fund to see if they're liquid, if they have debt issues, things like that. So in closing, just do your research. If you're really scared of a market crash, if you really want to preserve capital, putting money into short-term bonds might be something to do. Just remember that bond distributions are fully taxed unless they are certain types of bonds, so you aren't going to get those qualified dividend perks. I hope that helps, and thanks for watching.